Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Friday, December 12th. We have got a great show lined up for you today. First up, we are diving into OpenAI's GPT 5.2 with a researcher at Harvey who had early access to the model. We'll then dive into Broadcom's earnings, and separately, it is IPO day for Wealthfront. I'm talking to the CEO in just a few minutes. I'm also speaking with the CEO of Rubrik, and we've got another edition of the Editor's Cut. We're going to be talking with two of our top editors about how crazy a week this was for Larry Ellison making big bets. And finally, we will end with a little trip to the New York AI Summit. I sat down with the co-founder of Nebius to discuss his fast-growing business. It is a big show, so let's get right on into things. OpenAI has released a new version of GPT-5. It's called GPT 5.2, and any kind of release from OpenAI these days is certainly notable given the code red that the company called less than 2 weeks ago as competition from Google ramps up. Joining me now to break this all down and hear his thoughts on the model is Niko Grupen, head of applied research at Harvey. Niko, welcome to the show. It's great to have you here.
Thanks for having me.
So what did you think of it? 5.2, give us the review.
Yeah, so we did indeed have early access to GPT 5.2. And, when it comes to evaluating any new model, we're really going to ask three questions, right? What are the sort of innate reasoning capabilities of the model? We have our own internal benchmark. It's called a big law bench. It measures the ability of LLMs to complete real world legal tasks. The second question is, how does the model perform in the product? Right, we're going to wire the model up in the product, and we're going to run end-to-end evals across sort of our key product surfaces. And then the third question is, what do the lawyers think? Right, and this is actually, my favorite part of the sort of new model eval process is it's more unstructured testing. So we'll give the model to our internal lawyers. What they're really probing for are sort of step change improvements in things like legal.
So you give it to the customers.
To our internal lawyers. So at Harvey, we have a legal research team internally. They're all former big law attorneys. Yeah.
Got it. Okay, so three vectors. You've got the benchmarking. You've got the lawyers. So how are people thinking about it?
Yeah, so these three kind of signals coalesce into our general opinion of the model and sort of what emergent behaviors we've seen. In terms of overall performance, we're actually quite impressed with the model's performance. So on Big Law Bench, this is our public benchmark. It's the second highest scoring model we've seen to date. So it's inherently a strong legal reasoner. But I think the thing that stood out to us most about this model in particular was the model's inherent sort of guardrails. Right. So this came out in our unstructured testing phase, and we noticed an inherent or sort of emergent behavior where the model displayed stronger capability awareness. Right. So it's able to ask itself things like, do I have enough information to answer this question? What can I do? What can't I do? Should I bring a human into the loop? These sort of behaviors were pretty prominent and noticeable and are actually extremely beneficial for our platform.
Who was number one on the benchmark?
So that is actually GPT 5.1, right? So what we see is the frontier models from each lab. So GPT 5.1, GPT 5.2, Sonnet 4.5, and of course, Gemini 3 Pro. They're converging to the same sort of mean or average level of performance on our benchmark. And that's what we consider sort of the frontier cohort.
Help me understand the calculus here for these model companies in terms of when they decide that this is a decimal point increase, a 5.1, a 5.2 increase, versus, hey, this is a brand new model. What do the deltas here look like, and when do they decide that, this is enough of a big step that we should launch a new model altogether?
Yeah, it's an incredibly challenging problem. I think the model providers are working by proxy on the benchmarks that they can create, right? And the big challenge there is, can you build benchmarks that are representative of the ways in which these models will be used in the real world, right? And so the model providers will make progress. They'll hill climb against these benchmarks. When they've seen meaningful improvements, they'll give them to, model consumers like ourselves and ask us for feedback. Right. And so a big thing we're looking for are sort of these step changes in behavior, emergent behaviors, and it's sort of a feedback cycle.
So you were overall impressed with the model. I wonder, when you talk about feedback, what feedback did you give to OpenAI in saying, hey, this could use some work?
Yeah. So, I mean, the strongest piece of feedback we gave was certainly around the model guardrails, right? And this isn't necessarily negative feedback. We were actually impressed with this performance, but it was an emergent behavior that we hadn't seen from the GPT sort of predecessors.
Hmm.
In terms of room for improvement, I think the things that we identified were, the model is a bit rigid in terms of styling, formatting. It has its own sort of preferences baked into its weights there, and it's harder to coax out these changes in prompting. And then with legal specific use cases, we did see the model perform notably better on transactional legal work than on litigation work. So these are the kind of feedback signals we're giving.
And I just want to go back to again where you said 5.1 was the highest on your benchmark. So based on your comparisons of 5.1 and 5.2 against Gemini 3, Gemini 3 is the one that made a lot of noise. You're putting 5.1 and 5.2 ahead of Gemini 3 right now. Am I understanding that correctly?
Yeah, and what we're talking about here are decimal points of difference, right? So the current leaderboard is 5.1, 5.2, Sonnet 4.5, and Gemini 3 Pro. Again,
Okay.
these are within marginal mean kind of differences. The thing
And
that's more important for us is not the mean score, but where are the sharp edges for the subtasks of legal work that we're most interested in.
let me ask you a question here about this trend that there's this race to develop the best model and find which model is the strongest. There's also a discussion saying, hey, people might not need the best model all the time. We hear this discussion coming up with open source models that, hey, we just want to customize the model for what we need it for. Where do you sort of land on this spectrum of we should be focused on the best model or we should be focused on making a custom model that is just good enough for what our company needs?
Yeah. Yeah, I mean, look, the framing here is entire AI ecosystem is moving at warp speed, right? We had GPT 5.2 yesterday, Gemini 3 Pro and GPT 5.1 just a month ago, and Sonnet 4.5 about 2 months before that. So things are moving really, really fast. At the application layer, we're of course also familiar with urgency and sometimes what it takes to drive urgency. The things that we are prioritizing above everything else are model performance, production readiness, and client preferences, right? So model performance is measured by the benchmarks we just mentioned. Things like production readiness do come into play and our trade-offs with quality, right? So things like security and privacy, regional availability, and latency, reliability, all of these things do factor into the model we ultimately end up shipping to production.
Great. Well, Niko, thanks for coming on the show. It's great to have your review, and we will talk to you again very soon.
Thank you.
Okay. Broadcom reported earnings last night. Revenue growth accelerated to 28%. Free cash flow jumped 36%. It wasn't enough to encourage investors. The stock initially moved up in after hours trading yesterday. It then erased those gains during the earnings call and swung negative, and it opened in the red this morning. To break it all down, I want to bring on Tomasz Tunguz, general partner at Theory Ventures. Tomasz, welcome back to the show. It's great to have you here.
Great to be here, Akash. Thanks for having me on.
So, what did you think of the results?
I think the AI ecosystem is on a knife edge right now where any perceived weakness, real or not, or any like satisfaction of expectations leads to pretty significant drawdowns. I mean, you look at the overall growth of Broadcom relative to NVIDIA, it's not growing as fast, although it is much more of a services business than NVIDIA. You have the Google TPU business, particularly with Anthropic, that seems to be growing pretty quickly. Meta is a very significant customer, spending a lot, massively increasing their CapEx spend at the expense of their virtual reality ecosystem here. And so you have a very, very healthy business, great margins, great cash flow from operations, approximately just between 25 to 27%.
Right.
You have a pretty significant backlog. And I think the only thing that you could pick at the overall earnings statement was that some of that RPO might be a little bit, remaining performance obligations might be a little bit more delayed relative to where analyst expectations had thought they would come in.
I mean, look, let's call it what it is. I thought the numbers were good. To be honest,
They
like
were.
I mean, you have accelerating revenue, you have free cash flow. They talked about the big customers they have using the XPUs: Apple, SSI, Anthropic, Google, a fifth customer that they didn't want to name on the call, but they obviously have been working with OpenAI in some capacity, whether or not it's that fifth big customer. The thing that I was looking at this morning was the valuation of Broadcom relative to NVIDIA. And based on the revenue estimates, Broadcom is actually trading higher, which I think might be what people were getting at.
I think that's right. I mean, you have very elevated multiples. And I mean, we know from all the previous hardware cycles, whether it's telecom or also hardware, hard disks, that any miss here, you have a very significant drawdown. And because of the CapEx here so intense. So if there's any weakness whatsoever or any perceived sign of potential weakness in the future, I mean, you saw it with Oracle earlier this week where the RPO was absolutely massive, but the timing of that RPO remains unclear. And will people actually end up using this?
Hmm.
I think that's the major factor that people are trying to understand. Like, okay, OpenAI is committed to spending a particular amount. Google is committed to spending a particular amount. CapEx is growing. It'll probably be somewhere close to 3% or more of US GDP next year in terms of data center build out. Will the inference be there? And all signs point to yes, but if there's any indication that there's a deviation in that plan, then the drawdown will be significant. And so I think that's why you have this sensitivity. The only other way I sort of interpret the market is a bit of profit taking. The stock has ripped this year, and there's tends to be some profit taking before the end of the year, and so maybe that's another reason.
Well, it certainly would be a nice Christmas present for sure. I want to ask you about Hock Tan. We wrote this great profile about Hock in our weekend magazine last week, and he's an iconic CEO in the world of chips. I wonder what the discussion is in Silicon Valley about Hock Tan as a leader. You know, what do people make of his leadership and the way that he's running the company?
Yeah, I mean, I think he's done a phenomenal job, right? You see the core technical advances. I mean, Broadcom is some of the best technology to what's called serialization and deserialization technology, and the speeds there on the GPUs, I mean, are 224 gigabit per second. Nobody else can come close. You know, there was a rumor that Google might be bringing some of this capacity in-house for the chip design, but I think given the relative performance of Broadcom compared to Marvell and Synopsys, it's really unlikely. So I think he's done a really nice job building a pretty phenomenal business. It's also diversified, right? Compared to NVIDIA, where 75 to 80% of the revenue now is primarily within data center. Broadcom has an AI business that's growing about 75% per year, but it represents something like 30% of the overall business. And so if there were to be a drawdown, you have nice core intellectual property. It's very difficult, even for the hyperscalers, to replicate. You're talking about hiring thousands of people, pretty significant engineering investment over the course of multiple years to come anywhere close, and then a nicely diversified business. So to your point, like it's kind of a head scratcher about the overall stock performance given this business.
Well, I was texting with some analysts last night during the call, and if you look at the stock movement, basically after this first question that analysts asked about Google bringing the capacity in-house, right? That was the answer that they were not very impressed with, investors I'm talking about. And analysts sort of said he didn't give as reassuring an answer as they would have hoped about their advantage there. I wonder how much of a threat you think that is to Broadcom's business, this idea of customer-owned tooling, I guess, that they could design their own custom chips on their own in-house. It seems like a big endeavor.
It's a huge endeavor. These are massively complex systems, and there are many different dimensions to it. So, I think 2 or 3 years ago, there was the rumor that Google was trying to build this in-house. Google pays something like 30 to 50%, according to analyst estimates of the BOM for chip design. And so you can imagine that this will be an important thing for them to be able to do at some point. And it's incredibly technically difficult. No one has come close on some of these throughputs on particularly the serialization, deserialization component, where you can imagine a GPU is processing a huge volume of data in parallel. It has to aggregate that to send it to the next step. And then that next step has to take it and deaggregate it and parallelize it. That's the bottleneck for a lot of these GPUs systems, aside from in and around memory. And so as long as Broadcom has head and shoulders advantage there, then I think they'll still have a phenomenal business. But if you're Google and you're trying to compete with them or trying to capture more margins on the TPUs and Meta and others, will you be trying? I think you will be trying, but I can't imagine this changes in the next 2 or 3 years.
Great. Well, Tomasz, it's always a pleasure to talk with you. Thank you for coming on the show. We really appreciate it.
My pleasure is mine. Thank you, Akash.
Talk to you soon. Okay. Wealthfront is going public today in an IPO that values the company at $2.6 billion with all the stock options included. The company has built its business on robo-advisory and services. It also has cash management products and is moving into the lending business as well. Joining me now is David Fortunato, CEO of Wealthfront. David, welcome to the show. It's great to have you here.
Thanks so much. I'm excited to be here.
Well, congrats on a big day for the whole Wealthfront team. I want to talk a little bit about the IPO window, which is something we've talked a lot about on our show. Look, we talk about it opening and closing. Why did you decide ultimately that this was the right moment to go public?
Well, so there's a long answer to that and sort of a short timing thing. The short timing thing is we were planning to go public in October, and obviously we're impacted by the government shutdown. We got together with our advisors as the shutdown lifted, talked to investors, and the feedback that we got was we were in good shape to go. If you think about the longer sort of trajectory of Wealthfront's history, we've been a profitable company for years, have been growing consistently, have done 26% year-over-year revenue growth, and have continued to make progress towards being a mature company. We felt like this was the next step for us.
Now, you guys have built a business on robo-advisory, which has been around for a long time. Now we're in this new era of AI, which seems like a natural application for the technology. I wonder if there are scenarios here where you think AI is not well suited for wealth management and what parts you are not applying it to in your business.
So we don't apply it to our core investment strategy. If you think about the things that AI is amazing at, its use of natural language and being able to apply complex judgment. In the case of kind of best of breed passive investing, these are things that have been set out by academics for long periods of time. We apply those time-tested academic strategies. We make them very low cost to implement, and we share the savings with our clients so that they can get the best outcomes at extremely low cost.
And so what are you using it for then?
We use it across our client support, engineering teams. There are very interesting applications in financial planning that we'll work on over time. We're very excited about the possibilities, but for investing, we want to stay focused on time-tested, academically proven strategies.
But I just want to go back to it. So with respect to passive investing, and you talked about the academics having studied this stuff for decades, So you don't think there are any applications or any suitable sort of scenarios where AI should be able to make the decision for you based on all the data that it's collected?
I mean, the core of passive investing is basically looking at an optimization problem based on expected return and risk. It's a relatively straightforward mathematical equation to solve, defined by Harry Markowitz in the early 1960s. There's been research that's gone into it with Black Litterman. There are obviously views that you could express with AI tools, and some people have tried to do that. It's still very early to do that. One of the things that's, I think, different about investing is that it's a competitive market. There are everything that you do, you get reactions to. And so if you look at the big trading firms that do or are starting to use AI, they are being very careful with it because everyone else is competing with everything that they do and updating on a real-time basis. It's not something that you can just implement an AI strategy and then let it run forever.
Let me ask you about another flashy technology that I trust you're probably staying away from, at least in the near term, which is prediction markets have taken the world by storm. And stick with me for a minute here. Just as an outsider looking at this flashy sort of, quick-moving trading ecosystem that is popping up around prediction markets, what are your thoughts on it?
Well, so there's been a bunch of amazing research that's come out of UPenn. Philip Tetlock as a professor talking about the importance of both teams of experts and his judgment project, the Good Judgment Project, and prediction markets and how they work. I think it's a fascinating technology. It's amazing for learning about things. It obviously is used for speculation. It's very difficult to see a long-term investing angle to prediction markets because it's a negative-sum game. The fees to run the exchanges end up taking out, expected return from prediction markets. And so if you were just to invest randomly in prediction markets, you would expect to lose money over time.
And what about these other tokenized offerings for private companies and being able to buy some kind of a proxy for a share for OpenAI and stuff like that? There's so much out there now. What do you make of it?
Yeah, I mean, I think it's a tough market to be successful in. Obviously, companies are valued extremely highly. There's a lot of risk in those companies. I think if you look at the venture returns as an asset class and compare that to the NASDAQ 100 or other tech-focused indexes, really a diversified portfolio that invests in many things is likely to do better for individual investors.
What's the average age of the people on your platform?
The median age of a client on Wealthfront today is 35, but new client cohorts are coming in with a median age of around 24 years old.
And you started the company a while ago, and I wonder if you can speak a little bit to how you've seen investing change among young people. You talked about the new joiners, right? I mean, you talk to people in their early 20s all the time. How are they talking about it differently compared to when you started the company, or when the company started, I should say?
Well, I think what happens is there's a group of investors in every generation that's interested in speculation and taking advantage of the opportunities that they think that they can bring to the market. And there's a group of folks that are more focused on their families, their careers, and building wealth over the long term. We don't attract people that are interested in the speculative opportunities that exist in the market. We attract people that are focused on their families, focused on their careers, and building wealth gradually by saving every month and putting their money to work. They want to delegate that to someone, and we want to be the folks that they delegate that responsibility to.
Great. Well, David, congrats on the big day. It's a big step, and like you said, it was months and years in the making. We'll let you get back to the festivities. That is David Fortunato, CEO at Wealthfront.
Thank you.
Okay. Shares of data management company Rubrik have more than doubled since its IPO last year. The company recently reported its third quarter results, 48% revenue growth from the prior year. Free cash flow was more than 4x what it was this time last year. Joining me now to discuss the company's playbook is Bipul, Sinha, co-founder and CEO. Bipul, welcome to the show. It's great to have you here.
Thanks, Akash. Excited to be here.
So, look, I want to talk to you a little bit about the growth you guys have been seeing. Where is 48% revenue growth coming from?
We are delivering cyber resilience to every business and government around the world. And cyber resilience is the number one cybersecurity category because everybody has spent so much money in prevention and detection of attack, but attacks are still happening. You can't prevent the unpreventable. And our strategy is that be ready for attack that is inevitable and ensure that your businesses are up and running even when they are confronted with an attack.
Now, we talk about attacks. I do want to talk a little bit about the broader landscape here of AI and what it means for cybersecurity. But sticking with the growth here, is the growth largely coming from existing customers spending more, or is it new customers?
Rubrik has three core pillars for our business. Our core pillar is data protection, which is the business that is at a scale and we are growing it quickly. Then the next business is identity resilience, which is a new business that we created about 3 quarters ago. And we hit 20 million ARR in just 3 quarters. We doubled the number of customers just in Q3, and it's very fast ramping business, early days, but very exciting. And the third part of our business is our agentic operation, which is a new product that we just launched. So we are delivering resilience everywhere across data, identity, and AI. And if you look at the combination of all three, this is where the what is driving the demand and what is driving the growth.
And you know, if you think about these customers that you're serving, you know, one of the things that we've been talking a lot on the show is how much M&A companies need to undergo to be able to offer these new innovative products, given that they can't seem to build things fast enough in this fast-moving landscape. Look, your stock is trading higher than other software companies, at least on a multiples basis. Are you looking to do any M&A?
Rubrik is a unique company in terms of our culture. And we obviously have both organic and inorganic strategy. But if you think about identity resilience, a new business that we created completely organically from scratch and able to launch it. So that shows that our engineering, our product, even at this scale, is very, very innovative. And then we are layering on top of it team, products, technology to accelerate our roadmap. So we are always open. We are looking at great teams, great technology. We just acquired Predibase, which is an AI model fine-tuning and serving platform. We want to serve our customers, whether we can build it or we can acquire.
Do you think AI is net good or net bad for cybersecurity? Because we've been hearing a lot on this show about how AI makes it a lot easier for attackers to come at you in different ways, shapes, and forms. I'm sure it has ways to protect you as well, but it seems like it's making the game a lot scarier.
I'm in the overall IT industry for over about 30 years and doing technology for a long time. Look, any technology that comes in, it has both positive and negative impacts. If you look at AI, it's no different. Has given 100x more opportunity to everyone, but also it creates 100x more risk. And what we need to do is we need to give organization a framework to govern AI, to have confidence in scaling AI while ensuring that they can deploy agentic work to actually accelerate their own business and be competitively more viable in the marketplace. And that's why we launched Rubrik Agent Cloud that delivers agentic operations while managing risk. In fact, we say unleash agents, not risk.
But will it be enough? I mean, do you anticipate we're going to have more of these large scale attacks because of AI?
Attacks are inevitable, and bad actors will use AI in some ways more than good actors because they don't have to deal with compliance and governance. So the good guys have to do AI plus plus, which means that they have to be more aggressive in building on top of AI, utilizing AI, and making sure that their businesses are protected against these attacks by not just doing prevention and detection, but ensuring resilience.
Let me ask you a quick question outside of Rubrik for just a minute. You mentioned you've been in the IT sector for decades now. You started your career at Oracle, and it's a company that has gone through many transformations since you were at the company. Uh, what do you make of the scale of the bet that they're making these days in the cloud?
Look, you don't bet against Larry Ellison. I worked for him for almost a decade. He is the person who tracks the market, spots the opportunity, and switches quickly. And that is the hallmark of tech industry and founder ecosystem. And if you look at how fast he has gone into the cloud business specifically for AI, and how fast he's ramping up demand, I'm eh, honestly inspired by what he has done, and that is what is needed for American technology sector and for overall Silicon Valley economy to
Right.
spot the opportunity and move fast.
But then you see these stats. I mean, Torsten Slok over at Apollo, he put out this chart. I think it was last week at some point. I mean, the data that he showed at this point is that for large enterprises, AI adoption is actually starting to plateau. And at the end of the day, it's the demand that ends up giving confidence to people who are underwriting the debt here. What do you think of that?
Look, the reason that large enterprises are a little hesitant on AI is not the technology. It's about the governance and confidence that somebody sitting in North Korea is not running their business operations through agentic compromise. And so you will see this flip very quickly as Rubrik and others are providing more and more technology. The confidence will go up. I personally believe that we are at the cusp of massive ramp up in the inference, which is truly the enterprise business and part of the consumer AI technology. I'm very excited about what's ahead.
Great. Well, Bipul, thank you so much for coming on the show. It was a great conversation, and look forward to talking to you again very soon.
Thanks, Akash.
Okay, it is time for our weekly Editor's Cut, our Friday special segment where we bring on the information's editors to give us a glimpse into the discussions that are dominating their editorial meetings over the past few days. This week, the tech and media news headlines were dominated by one family, the Ellisons, and specifically with Larry Ellison leading Oracle and also backing his son David Ellison and Paramount's ambitions to buy Warner Brothers Discovery. We want to focus on the scale of the bets that Larry is making. Joining me now to discuss that is our co-executive editor, Martin Pierce, and our features editor, Nick Wingfield. Welcome to you both. It's great to have you here.
Hey, Akash.
Hey, thanks for having us.
Okay, it's the Martin and Nick show. And Martin, I'm going to come to you first. How are you thinking about the scale of the bets that Larry Ellison is making, not just at Oracle, but also in media?
Well, I should start by saying that Nick is much smarter than I am about tech. So, and in the editorial meeting, we don't tend to argue too much. So let me just lay the groundwork and make that clear. Nick and I have actually worked together for 25 years, so we actually know each other pretty well. I think the scale of the bets are great, but it's clear to me that the much bigger bet is the one he's making at Oracle. I mean, Oracle is investing an undefined amount of money in expanding its AI business. It's very reliant on OpenAI, and no one really has any idea how well that company will actually do it, and whether or not it will be able to afford the commitments it has made to buy cloud computing from Oracle in 4 or 5 years' time. On the other hand, Ellison is making a big bet on the entertainment industry, but the scale of it in terms of his personal wealth is not that great. He put about $6 billion into Paramount, and he's committed at least 12 into the Warner deal. He's on the hook to back the entire equity amount of 41, but he really won't have to put up all of that. So even if Paramount goes to zero, even if the equity goes to zero, he won't lose that much. Whereas most of his wealth is in Oracle, and if that stock falls a lot because of the AI bet, then he would lose a lot more.
Okay. Nick, do you agree that the Oracle bet is the riskier bet? Seems like a foolproof argument.
Yeah, I agree with Martin, but I'm going to try and argue the opposite in the interest of making this discussion a little more stimulating. And first, I'm going to take a trip down memory lane, which is when Martin and I met 25 years ago. We met on the day that a now long forgotten company called AOL acquired Time Warner, the predecessor to Warner Brothers, or at least the Warner portion of the Warner Brothers Discovery company. And that turned into one of the biggest fiascos in certainly media deal history, if not corporate mergers and acquisitions. It was a terrible deal, and the fact remains that most media deals are bad.
Why was that one bad though?
Oh, there were so many reasons. You're going to stretch my memory, but basically, AOL had a inflated currency, its stock, because of a lot of questionable deals that they struck. Martin, do you remember the other particulars around?
Well, the other reasons were that AOL was built on a selling internet access to people, and the deal happened right as broadband was emerging, and that completely destroyed the AOL business. And the other issue is that there was such a cultural clash between these two companies that it prevented them from actually working together.
Okay, so Nick, finish your point now. So you were saying.
Right. So that the collapse of that deal ended up being like, the first line, or will be the first or second line in the obituaries for a lot of the people who are involved on both sides of the company. So if this deal, basically, if this deal happens, there is risk that it ends up souring and being an embarrassment for the Ellison family. If the deal, but there's also a question of whether the deal can get done. It still has to go through regulatory approval. The Ellisons, I think, have argued that they have a clear path to getting it approved by regulators because of their, shall we say, friendly relations with the Trump administration. But it's not a slam dunk. And without Warner Brothers Discovery, you could argue that Paramount is destined to be a failure, and that could end up, if not, damaging the wealth seriously, or as seriously as Oracle's collapse would. It would be a huge embarrassment for Larry Ellison.
Well, and Martin, is there an argument to be made here that the Paramount deal, the media deal? I mean, this is an industry that is, going through transformation. Much of it is in decline, right? I mean, you're putting your money into this area that does not have the rest of the world sort of on its tailwind. Whereas the AI play, it's risky from a capital perspective, but I mean, this is the thing that people are talking about is going to carry much of the economy in some cases for the next 10 years. Don't you think that it's riskier to go into this shrinking industry for Larry Ellison?
There's no question that the entertainment industry for decades has attracted people who don't know anything about it, who are attracted by the chance to go to the Academy Awards and to, just feel like they're really cool. And the business itself is really a bad business, and it's particularly bad right now. And yes, if whether or not the Ellisons manage to succeed in this takeover bid, their chances of actually making any significant amount of money on Paramount are not very good. But you look at it from the other point of view, which is that at 83, I think he is, Ellison is betting the ranch, really. He's really betting the future of Oracle, the company he founded, 45 years ago, on this unproven technology. He's trying to compete with Amazon, Microsoft, and Google on the cloud front. It's an enormous bet, and I think the amount of money he stands to lose is much greater in Oracle than in Paramount, even if you assume the Paramount thing is a complete disaster.
And I should say, I just Googled it. He's 81, Martin. So he's not quite 83.
Sorry, I overstated his age. That's really terrible.
Okay. So Nick, I mean, does this just come down to a father-son story at the end of the day? I mean, is that the business case here?
I'm a movie guy. I really, really love movies. Some of my favorite movies this year were Warner Brother.
Let's be clear. Nick doesn't know anything about the entertainment industry. So when he says he's a movie guy, he likes to watch movies.
You just started off by saying Nick is smarter than I. That was what you opened the segment with.
But
well,
look,
of course, but
So I mean, that was my point. I'm not saying I know the industry better than you do, but I love movies, and maybe, just maybe, Larry Ellison feels like, he'd rather own this.
This is why people go into the industry. They love movies. This is the problem with the industry. All these morons go into the industry because they like to watch the movies. They don't understand. It's a terrible business. No one should be investing.
Larry Ellison has more money than he could ever spend. There's more to life than money. Maybe he wants he wants to be able to protect these beautiful Hollywood assets.
Yeah. So okay, let's think of ourselves as reporters now. If you were to, as you think about the reporting questions, Martin, what are the big questions that you think that journalists should be out there trying to figure out with these deals in play?
I guess I would be trying to figure out how much money is Ellison personally putting in? Where is that money actually coming from? I mean, Oracle has said in its filings that Ellison has borrowed against about a third of his Oracle stake. We don't know what the impact of the Oracle price falling has had on that particular arrangement he's got, but I would be interested to find out, is he financing his investments in Paramount via his Oracle, the loans? So that's one question. And then the other question is, how much money is Oracle have to raise on the AI front? That's the single biggest issue. And when they were asked about that this week, they really did not give any kind of specific answer.
And Nick, what are the questions that come to mind for you?
I mean, I like a lot of Oracle's success in cloud is based on a big customer, OpenAI, so I think understanding, whether OpenAI can follow through on its cloud commitments to Oracle, whether it has the money to do it, whether the growth is there for its product, a lot of that actually, certainly influences Ellison's wealth. And so putting all those pieces together and seeing how they impact this deal is one way to approach the story.
And let me just go back to the entertainment industry for 1 second here. Look, one of these deals, maybe we'll go through. It's either going to be Netflix or Paramount. It'll still be a while before we figure it out. But in the story of media companies constantly taking over each other, merging, breaking apart, which of the two do you think may end up better? Which of these two deals has a higher likelihood of eventually just selling a piece off to another company or splitting apart or eventually going south? Martin, do you think?
I mean, I've argued all along that I think the Paramount deal, it makes more in that, it's a more logical bet. I mean,
Right.
Netflix, I think, is a very good, strong company. It does not need this.
Okay. Nick?
Well, if you ask people in Hollywood, from what I've read in the trades, the Netflix deal is going to be better in terms of jobs. So it depends on what perspective you're arguing from. The synergies that Paramount is projecting from this deal imply a much higher level of redundancies and cutbacks. With Netflix, it's less. There certainly probably will be some job loss, but I also think a Netflix deal is probably worse for the theatrical experience, just because their bias is in streaming, and I still like to go to the movies.
Great. Okay. Well, what movie are you seeing this weekend, Nick?
I don't have any plans. What should I see?
I want to watch Jay Kelly. That's the movie
It's
on
on Netflix.
Yeah, it's on. Well, I didn't say I wanted to go to the theater. I said I wanted to watch the movie.
Yeah.
All right. Well, thanks a lot for coming on, guys. We'll talk to you next Friday. That is Martin Pierce, our co-executive editor, and Nick Wingfield, our features editor here at The Information. Okay. The AI infrastructure build-out has become one of the most closely watched stories lately, with data centers popping up left, right, and center. And to cover it all, The Information is teaming up with Nebius on a new weekly newsletter called AI Infrastructure, where we'll go deeper on the most important developments in AI data centers and computing. That newsletter launches on Monday, December 15th. Nebius, of course, is a fast-growing company in the business of neoclouds, which we have covered in great detail. I had a chance to speak with Nebius's co-founder, Roman Chernin, about all the dynamics that he is seeing in his business at the AI Summit in New York City this week. Here is that conversation. Roman Chernin, welcome to TITV. It's great to have you here.
Yeah, thank you for having me.
Well, I'm excited to talk to you all about the business that you guys are building here. Look, I want to start with cloud vendors are a business that people know very well. They've been around for many years. There are some big players in the space. You belong to this category of neo-cloud players, which
I
is
don't like
fast-growing.
this name, to be honest, but yeah.
What would you rather call it?
AI specialized cloud.
AI specialized cloud, okay. But, it kind of gets at a point that I wanted to ask you about is how do you look to differentiate yourself?
Yeah, that's why I mostly like AI specialized cloud, because actually it gives the sense of what we do.
Right.
And I think in general, what we do is specialization. So we laser focus on AI workloads. We do the best to extract every single point of a kind of performance and reliability in these particular scenarios. And that's how we compete.
So help me understand this, though. When people say, well, the big three cloud providers, I mean, they all have their own AI specialized cloud offerings as well. How do you think about competing against that? I mean, is it on software? Is it on customer service?
Yeah, it's across all the stack actually, but customer service is a tricky part. Our CEO says it's easy to be good to your customers when you have hundreds of them. Stay cool when you 10,000 and 100,000. So it's not it's the way how you win at the beginning.
Right.
It's true, but it's not like the mode. Right? When the mode probably comes more from building the stack. And what we do the full stack. We all the layers from physical infrastructure all the way up to the not application layer, but platform layer.
Right.
We sit here in front of Token Factory, which is our the newest layer of the offering,
right.
Inference platform. So, and we optimize across the full stack on one purpose. AI workloads should be the best. And I think that I don't want to say for other players, but you cannot be fully specialized when you are universal.
So you guys are going deep in one.
Yeah. So
right.
And it comes from many details, but if you think about the platform layer, if you think about orchestration layer, if you think about even hardware layer, you can win by focusing on one workload or two workloads.
Well, one of the things that you are focusing on with your Token Factory offering and with the software is you're a big proponent of open source AI models. And it's a conversation we've been having a lot on the show is the future open source? We know the leading models right now are closed source. You seem to be a proponent of open source. Do you think that open source models will inevitably be the most powerful models in the years to come?
I don't think this is the question. I think that the landscape will be more complex than one model wins all. So I think about it as a maybe triangle. So you have the most powerful smart models, and today they are closed source. You have the models where you maybe not need the smartest models, but you want cheaper or lower latency. And this is very good fits to the open source because you can do a lot of optimizations, like for particular use case to reduce the cost and latency. And then you have the question of applying your data. And then like, if you have a very specialized workflow, you can take maybe not the most powerful model, like not the smartest model, but good enough, and improve it with your data, like fine tune. And then in your particular use case, it will be smarter than the general smart model.
So maybe not better than other models, but better for you.
Yeah, better for your particular use case. So
right.
Like, and then the use cases for open source mostly driven by the need to reduce the latency and the cost or apply the data. And then if you need the general intelligence, it probably will still come from the SOTA models. But if you need to go down to optimization or apply data, open source will find its place.
You mentioned cost, and I want to talk about Nebius's costs for a moment here, because look, it's a capitally expensive operation. We know that. In the past, Nebius has had to go to the debt markets to fund its operations, and the company's growing fast. My sense is you'll have to go back to the debt markets at some point in the near future. How is that conversation looking for you on the ground? What are the big questions that bond issuers and people issuing these loans are asking you?
Yeah. So I think that important to say that until now, we were in the market of convertible debt, and we looking now in asset-backed financing that is very natural for the business that we are running. And we also look for other opportunities of a corporate debt moving forward. But the important kind of part of our DNA is we want to be very cautious to the terms.
Right.
So all the financial, all the fundraising we did, all the financial deals we did, and actually all the customers we signed, we always are very focused on the healthy margins, because this is the business of the scale, but this is also the business of the cost structure. So we are very opportunistic. We look in like all the types of the tools we can use from the financial side, but we always prioritize like the healthy deals.
Now, you talked about cost structure. I'm curious, would you ever think about raising prices in the future, given how much pricing power cloud providers have in this day and age? I mean, it's a scarce resource.
Yeah, like the pricing today on the market is mostly defined by supply-demand situation. So, and I should say that, like, I would say we were very aggressive price player at the beginning of this year.
Right.
Because it was important for us to gain market share. And I think we were one of the very aggressive, and we could afford it because our cost structure was good. Now, today, and we told about it on the earning calls, and we are pretty sold out. And when you are sold out, you actually can choose the customer. And again, like we have much more factors to prioritize the customers rather than the price. But now a lot of customers we work with coming to us not for the lowest price. Why? Because they appreciate like the advantage of the platform, or they appreciate how fast we can move them to the value, or we have capacity that they need right now and they're ready to pay the margin for that.
So why not raise prices?
No, that's what I'm saying. It's not like we raise prices, but every deal has its specific terms. And when you're well positioned on the market, you have the right capacity, you have the right platform, you can choose the customers that's ready to pay for your advantages.
Right. I mean, your investors will like that too, because I mean, look, the end goal here is to get to profitability, of course.
Yeah, of course. But what I wanted to say also that I think the market in general is very much obsessed about like the pricing, when the TCO, which is more important thing, like the total cost of ownership, is kind of more complex metric, let's put it this way. It well more complex than just GPU price. You have reliability, you have the terms, the rest of the terms in the contract, you have the platform that enables you to extract more value. In the token factory, we provide the managed service. So we optimize the performance for the customer. And it's not so important for the customer how much GPU costs. It's important how much token costs. So I think that the market will move in a more educated stage when we'll think more ROI and total cost of ownership rather than the GPU hour cost.
You mentioned GPU, and you obviously are a big partner with NVIDIA. And I wonder what you think about other chip companies, about AMD, about Google's TPU. Any plans to diversify the offering?
I think it's great that the market has competition. I think competition in general is very good, and we benefit from competition on all the layers. So far, we are very much focused on NVIDIA. This is our key partner, key vendor. And in reality, most of demand we see is coming still for NVIDIA. So we are very close looking to everything that happens on the silicon competition layer. But again, today, we don't see a strong push for us to move from NVIDIA offering to other chips.
And so no conversations with Google about using TPUs, for example?
Conversations, it's not business. No, we talk with everyone.
Right.
And on engineering side of the things, we want to be very much in the frontier. So we test stuff, we talk with the different companies, but then the question where demand comes from and where economics come from.
Right. Let me ask you this. We're coming to the end of the year now, 2026 for Nebius. What does it look like for you? Where are you focusing?
First of all, it's the year of scale. We actually announced quite ambitious targets for the next year, both on our footprint scale and on the revenue scale. So we are we forecasting 7 to 9 billion IRR by the end of the next year, which will be impressive growth from where we stand now. And the same on the data center fleet and power fleet and so on. But another important thing that we very much focus on developing the product offering. And what drives us is we see that the profiles of customers are changing. So if
you guys are getting much bigger too, you have these deals with Meta and with Microsoft.
This is one part. But another part, and what's happening here in this conference is 1 year ago, most of demand, I think 99% of demand, actually came from people who build models. Large models, small models, specialized, doesn't matter, but people who build model and then run models. What we see now, we see a lot of customers coming from the product side. People who build vertical AI companies or enterprises that apply AI in different use cases. And they need different product.
Right.
They don't necessarily need rent GPUs. They need managed platform to run inference. They need managed platform to run post-training. So, and we develop our stack further, not only because we have a lot of fun developing stuff, but because we understand that the next wave of demand will come from different type of the customers that need different type of the platform.
Right.
And you can think about it like Microsoft of the world, they need bare metal, large bare metal clusters because they have all the software stack that they bring there. Then the next layer of customers like smaller builders of models,
right.
They need multi-tenant cloud because they they train models, then run them on scale, and they control kind of the technology, but they need cool service as a cloud, right? And it's like classical.
Everyone needs something different.
Infrastructure as a service.
Right.
But then when you think about vertical AI companies like Cursors of the world or Lavables of the world, they come for inference, or they come to tune the models and then deploy them. And they don't want to go down to the stack to rent the clusters. They want managed platform to run inference. And that's the next wave of consumption that we need to address.
Right.
And then 2027 will be probably the year of the enterprises that will need.
That's when they'll finally come online.
Yeah,
right.
Yeah.
Wow. It's a story that we've been watching very closely. Roman, I want to thank you for making time for us. That is Roman Chernin, the co-founder at Nebius here on TITV.
Thank you.
That does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank Amazon Web Services, who is our presenting sponsor for this production, and I want to thank you for tuning in. We really do appreciate your viewership. I'm already excited for our next show on Monday. Have a great weekend, and go to the movies. Bye-bye for now.